All right, ISHR, we are back with the second part of the video lecture. We just finished the lecture on the balance of payments and the current account. Now we need to look at the sort of other side of the equation, the financial and the capital account. These are basically sort of the balancing elements of the balance of payments. And we'll talk about that in just a second. Let's just define this first. Capital account is a record showing capital flows to and from other countries. So it's just showing the exchange of capital, and actually this account is actually not really that significant because there's so little money that flows in and out of this account that it is a very small impact upon the balance of the payments as a whole. And so just note that you will probably not be asked by this by the IB on your paper 2 test. However, it is still something that IB wants you to know, and so we have to go over it nevertheless. One thing to note too about the capital account, when we add it with the financial account, it should be the mirror opposite of the current account. Basically what that means is if we have a current account surplus, we're going to have a financial and capital account deficit. So if one is positive, the other must be negative, and they should actually end up resulting in a value of 0. And so that is sort of another important note about the capital and financial accounts. So let's get into the 2 components of the capital account. There's really only 2 components. Capital transfers, which is the net monetary movements of fixed and financial assets, and there are 2 examples of this in practice. One is basically debt forgiveness, when a country forgives the debt of another country. For example, if China was to forgive a lot of U.S. debt, this would be an example of debt forgiveness. And, basically the United States would have a credit and China would have a debit. Anyway, this is an example of debt forgiveness. And it's something that I dream about, but probably will never happen. Next, investment grants. This is when one country provides a specific grant or subsidy to another for a fixed asset. This might be, for example, for water pumps in Rwanda. If the United States government gives a grant to an NGO in Rwanda to build some sort of fixed asset, whether that be sewage or infrastructure like a bridge, this would be an example of an investment grant. And again, this doesn't happen a lot, so it doesn't really feature too heavily in the overall calculation. Next, we have transactions in non-produced and non-financial assets. So if one country purchases the rights to land or to a fishing area or for resource rights, mineral rights in another country, when you buy the right to fish in certain waters, right, it's a non-produced asset. There aren't any fish harvested there yet, and it's a non-financial asset. You're just buying the right to harvest something. The other example would also be patents, trademarks, and copyrights, any sort of intellectual property. That's a non-produced, non-financial asset. So if a firm was to buy a patent or a copyright in another country, this would be an example of a non-produced, non-financial assets. Again, these are so small that you probably don't, you probably will not be asked about them because they don't play a very substantial role. But still, we got to cover them. Okay, so let's go ahead and move on. Don't really worry about the rest of this. Just note that in the same way, if a country purchases a patent in another, right? Basically, this is an example of a debit because money is flowing out of that country and the patent is flowing in. Same with investment grants. If a country grants a subsidy or a grant to another country, that would be a debit because money is flowing out of that country. But don't worry about it too much because again, it's probably not going to come up. Let's talk about the important part here, which is the financial account, which is where the true counterbalancing comes in. Basically, it measures the flow of financial instruments assets and liabilities. And basically when we're talking about financial instruments, we're just talking about stocks and bonds. We're looking at the flow of stocks and bonds and derivatives, securities. We're looking at that flow. And so anyway, that's what the financial account measures. And basically the first major component of the financial account is what's called direct investment or foreign direct investment. And there are two kind of types of direct investment. It is when multinational corporations spend on long-term productive assets or capacity abroad. So for example, if Mercedes sets up a factory in the United States to build SUVs there, this would be an example of foreign direct investment because Mercedes is spending on capital goods in another country. They're investing abroad. It's foreign investment. So this is one sort of method of foreign investment or foreign direct investment. The other is when a firm purchases a 10% or greater stake in a firm abroad. If they buy the stock of a company abroad, this is an example of foreign direct investment. A good example of this happened a few years ago when Microsoft purchased Nokia. Nokia is a Finnish-based company. Microsoft is obviously the United States. And when Microsoft purchased Nokia, this was a financial account debit for the United States because money flowed out of the United States and into Finland. Obviously, it was a credit for Finland because money flowed in, but their assets, all the stock for Nokia, flowed out. And so again, this is foreign direct investment. So just know there are two types, either setting up a factory abroad or purchasing the stake in at least a 10% stake in a firm abroad is foreign direct investment. Next, this is very similar, but it's just on a smaller scale, portfolio investment. It's basically when an individual in a country or a small organization purchases stocks or bonds abroad. So, for example, if I buy a stock as an American in a Japanese company like Toyota, maybe I think Toyota is going to be doing really great in the next few years. When I buy that Toyota stock, money flows out of this country and into Japan, so it's a credit for Japan, but they're also the asset, the ownership of that stock is flowing abroad to another country. Please note that there's one element of this that's a little tricky. I've just bought stock in Toyota, and it was a debit for our country because money flowed out, and I purchased that asset. But the money I earn in dividends from that stock is not in the financial account. That investment income would belong in the current account because, again, the part of the current account is investment income. So the dividends from the stock is in the current account. When I buy the stock initially, that's in the financial account. So just note there is a distinction there. The final sort of element of the financial account is foreign reserves. Foreign reserves are just basically foreign currency that is held by the central bank. And the central bank buys and sells foreign currency and their own currency all the time. And it can lead to money flowing in and out of a country. For example, if the European Central Bank basically uses our foreign reserves to buy our own currency from other banks, right? Our asset, the foreign currency, flows out and our own currency flows back in. This would be an inflow because our own currency is coming back into our country or into the European area. Finally, again, if we buy foreign currency with our own currency, we're buying assets and our currency is flowing out, so it's a debit, but the foreign currency flowing in, which is an asset, flows in, so we have more of this backup foreign currency. So just note, financial account is FDI, portfolio investment, and foreign reserves. Those are the three components. You need to know that, and it's kind of part of the definition. So if I was to really define the financial account, I would say it's the measure of financial flows or financial assets and liabilities from FDI, portfolio investment, and foreign reserves. I just couldn't fit it all onto the slide in one line, so I had to I'm just telling you now. Anyway, let's move on to the an example of what a balance of payments might look like. Let's take Hong Kong, for example. You can see that the current account is 36.9 billion, so it's a current account surplus. Hong Kong has tons of exports, so that makes sense. However, the capital account and the financial account are negative. When we add the current account with the capital and financial account, we find that the answer is 0, right? The counts have balanced each other out, hence the balance and the balance of payments. So just note, this is a kind of a good example of these these three accounts rather. Okay, last little point before we go, let's do a quick quiz. Let's make sure you learn something. I'm going to give you 3 questions. Pause, see if you can answer the questions. If you can, awesome. If you can't, then you need to practice. All right, here we go. First question. What were the 4 components of the current account? Do you remember the 4 components again? What were they? Next, what were the 3 components of the financial account? And could you describe them? Could you define them? Finally, the balance of payments in theory should always equal what? What number should it always add up to? Hopefully you can answer these 3 questions. They're not hard questions. And we will see you on class in Monday. Thanks for watching, and Schulte out.